Welcome to Trading Nation, folks. I'm Eric Chemi. Today, let's talk about the broader market. The S&P trying to claw its way back into the green on the year. And with all this volatility rocking Wall Street, we got to bring in our next guest to cut out the noise, break down three critical charts for the market right now. Today, we've got Mark Newton. He's the president and founder of Newton Advisors. Mark, you've got a chart of the S&P 500, that just the core basic S&P 500. Right. Let's walk through these key levels that we got to watch.
Sounds good, Eric. So I thought it was important, first of all, to differentiate between the noise that we all hear versus the actual price action, because there are certainly well-defined trends that's important for investors to really pay attention to. Here's the S&P just since our January peak. And so these are really the key levels. Obviously, February lows is going to be very important. We see the 200-day moving average is also down there. Right now, we obviously have started to show more and more signs of bottoming out in the last couple of weeks. So that is very constructive. We've also exceeded the trend line just since the middle part of March. So those are two key positives with regards to short-term trend. Momentum has turned up. We saw some evidence of fear right at the very lows. We saw what's called negative momentum and divergence. In other words, momentum bottomed here. Prices went below the 200 briefly, but yet momentum was higher. So that's also a key positive. So we started to turn up thanks to technology, thanks to a little bit of financial strength, and the market has followed suit. So really, the last week or two have actually been very constructive for the short term. So my thinking is we can get up to right near 2750, and that's going to be an area to really reconsider, because the broader trend, as we see, still very much consolidation mode. A lot of consolidation. Weekly trend right now, momentum-wise, is negative, short-term positive. So it's a tricky market. As we know, all this news has been whipsawing prices all around, but the trends at this point are a little more constructive based on what we've seen this week.
It's amazing, before we go to the next chart, it's amazing you mentioned, we're trying to get to 2750, and you look at that level. We were just at 2850 at the beginning of that yellow line. So to think at that time, if you were having a conversation and say, hey, in a few weeks, we'll be happy to get to 2750, that's really a big turnaround there.
Well, I think investors are trying to come to grips with this new era of volatility, and it certainly seems like it's here to stay. And so, right now, we have to hit singles. We have to try to be tactical in our approach and think that, near term, the trends are trying to bottom out. So we take that for what it's worth, and simply right now ride the trend in the short run.
All right, so that's good on the S&P 500, the overall market. And I know everyone loves to talk about tech as their favorite sector, because all the volatility, all the growth possibilities there. What's your perspective on that with the charts?
Okay, so technology, and this is what's interesting also, is that despite the pullback that we've seen since the middle part of March, tech is still very much constructive going back over the last year. So we pulled back almost exactly to where we needed to see tech bottom out. And just the last week has been very constructive in that we've exceeded this downtrend from the middle part of March. So given that tech is over 25% now of the S&P, that's a short-term positive for this market. And we saw after the Zuckerberg hearings that Facebook has started to stabilize a little bit, and the FANG stocks in general have started to gain a little bit of traction. Netflix, obviously, with earnings early next week. And so the bottom line is tech is positive. We bottomed out where we needed to and have started to show signs of turning higher. And so for me, having that tech engine start to turn up a little bit is certainly one piece of the puzzle where, you really want to stick with that and think tech can move a little bit higher.
Talk about real briefly, what is that ratio that you've got there? So it's tech divided by the market, and it's tech represented, what is that, NASDAQ?
So this is the S&P Information Technology Index through Bloomberg. And so it's a broad-based index that obviously, it's not as heavily weighted towards large cap tech as you'd see in the XLK. But certainly important to look at broad-based gauges of technology relative to the S&P to really see where we are. Now, if tech doesn't take out the highs and we come back and take out these lows, and that would be a big warning signal. And it's not impossible to say that in the next couple months, this volatility, that something like that can happen. And so it's important to monitor the trends. For now, they've held and we seem to be turning up. And so, I'll take that in the short run. I'm thinking we can move a little bit higher.
It's interesting, actually, that chart, despite all the volatility, when you put that ratio together, has been pretty smooth. It's been gradually just moving up, but without anything crazy. So, but anyway, let's move on. Final chart. Let's get away from stocks a little bit. 10-year Treasury yields. What's going on with bonds, Mark?
So this is interesting also in that, bond yields and stocks recently have been showing a lot of positive correlation. And just in the last couple of days, we saw stocks trying to break out. Now we see bond yields actually breaking out above this 281 level. So, we've been choppy since the middle part of March in stocks and bonds. Now we see what I think is the global bond sell-off starting to reemerge. And so you see yields poking up above 281. This should help yields get up to right near 293 to 3%. So bottom line, this means that groups like utilities and REITs really are unattractive. You want to fade those, or for those that are looking for shorting opportunities, shorting the utilities, shorting the REITs, and think that yields can in fact move higher. At this time, everybody back in the peak, when we saw this right back here in March, everybody was thinking that bond yields had to go higher. The Fed's going to come in and hike rates, and it's going to be global growth has returned, and yields have to go straight up. And that's exactly the opposite of what happened. This chart is actually a mirror image of what we saw back in 2017. Yields peaked right near 260, went down through September to 2%. So right now we see a peak here. Everybody was shorting Treasuries, thinking yields have to go higher. In fact, we've been range-bound and choppy-like. But this move in the last couple of days, I think, is important for the bond market. It means that at least Treasuries to start to fall again, meaning that yields start to move higher. I think we should see the same thing in bunds really in the next week or so. We've seemed to have stabilized near 50 bips, and yields should start to go up there as well. So this is really a global phenomenon where rates have been choppy, but if anything, this argues that, right now it's right to be long TBT, get out of the TLT, think that we're going to see higher rates really in the weeks to come.
So you're saying stocks going higher and rates are going higher, and
That's
tech's
right.
going higher relative to stocks overall.
Yeah, we saw a brief period where stocks and bonds were positively correlated. Now we seem to have reverted back where, good news is good news, bad news is bad news, where, all of a sudden we see, recent signs of bond yields and stocks trying to break out at the same time. We saw the Qs and the S&P move up. And so my thinking is that's, certainly positive. Now it's tough. We're not above 3%. We're not above 305. And that's really the longer-term trend for Treasuries remains down for about 25 years. And so getting above that 305 would really be that next signal that, okay, we're going to start to really take off. And I don't think that's going to happen. So similar to the S&P, similar to technology, this is more of a tactical, shorter-term type trade. The next few weeks, my thinking is yields can, in fact, push up. If we get down below, right near 270, then really it's all bets are off. And we're going to see a bond rally again, which likely, based on the recent correlation, means that stocks and bonds, bond yields will likely start to pull back again. But for now, we'll emphasize the positive. Yields are starting to push up, and stocks have been on better footing recently over the last couple of weeks.
A lot of good stuff here, Mark. Really intriguing charts, especially this bond one. It'll be interesting to see what happens here in rates, but we'll just leave it there for now. Mark Newton of Newton Advisors, thank you so much for joining us today.
Thanks, Eric.
And thank you for watching Trading Nation. I'm Eric Chemi. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.